Hi, this is Merrill with Tax Tutor. I am a CPA. I've been helping business owners save money on taxes for over 20 years. We typically help us clients save $10,000 to $20,000 a year in taxes, but sometimes we get an opportunity to help a client save $1 million or more in taxes. You can say that it's really my purpose in life is to help business owners save money on taxes. In our video today, I wanted to clear up a misconception about taxes, and that is the difference between a tax deduction and a tax credit. They're two very different things, and they can become confusing to people. So we wanted to go through those and kind of clear up how those work. So both tax credits and tax deductions can lower your tax bill, but they work in two different ways. Tax credits reduce the amount of tax you owe dollar for dollar, while tax deductions reduce your taxable income, which can lower the amount of tax you owe, but it is not as straightforward as credits. And we'll get into some examples here shortly. So let's start with tax credits. So imagine you owe $2,000 in taxes, but you qualify for a $500 tax credit. Let's say maybe it's a dependent. Right now, other dependents over 17, 18, they qualify for a $500 tax credit. So let's say you owe $200, you have one of these dependents that gives you a $500 tax credit. That means your tax bill drops from owing $2,000 to now owing $1,500. It's a direct reduction of your taxes owed. There are two types of credits. One is a non-refundable credit. Non-refundable credits reduce your tax bill to zero, but you will not get a refund for any leftover credit. This was the credits for buying an electric car, like a Tesla, let's say. Those credits are $7,500. But if your tax bill is only $2,000, that Tesla tax credit will get you to zero, but it won't get you anywhere beyond that. I had a tragic case of a client once come to me. They were a new client. They went and got all these credits. They put solar on their house, they bought an electric car, they had all these things, and unfortunately they really didn't make much money and they did not have much of a tax bill. They really had nothing. They had a lot of dependents, and all those dependents, all those children, they offset their taxes to pretty much zero. So all this money that they put into solar and all the money that they put into buying an electric car, they got zero from it. They were expecting a huge refund to come, but unfortunately all those were non-refundable credits and they got really no benefit from them. So that's the downside of a non-refundable credit. You got to watch out which type of credit that you're getting. Refundable credits, on the other hand, these can reduce your tax bill below zero, which means you could get a refund for the remaining amount. For example, if you owe $500 in taxes and you have a $1,000 refundable credit, then you will get a refund of $500. Your taxes will go to zero. That will be actually the government sending you money, basically saying, hey, you got this credit, here's you money back. And so they'll actually send you money rather than you sending the government money. That happens all the time with earned income credit is a refundable credit. So if you're in the income levels to get the earned income credit, that's something that could come back to you. Some of the child tax credits for having children, if your tax is wiped to zero, there's part of that child tax credit that can come back as refundable, meaning that you get more money back than you actually paid in, or more money that you owed. And there's several other credits like that that are refundable as well. So it's important to know which credit you're working with as you're looking at tax planning. So now let's switch over to tax deductions. So a tax deduction reduces your taxable income, which is the amount of income that is subject to tax. For example, if you make $60,000 in a year and you qualify for a $5,000 deduction, your taxable income is reduced from $60,000 to $55,000. This means your tax savings depend on your tax bracket. So in that case, if you're in the 22% tax bracket, that $5,000 deduction will save you about $1,100 in taxes. So you take that $5,000 times 22, it's about $1,100. Examples of this include the student loan interest deduction, mortgage interest deduction, charitable contributions. Same thing works for a business owner. So if you're a business owner and your business made $60,000 and you can take a $5,000 deduction, then that will lower your tax about $1,100. Some people think that this deduction, like if they gave money to charity, let's say that they owed $5,000 in tax, and if they gave $5,000 to charity, their tax would go to zero. That would be a tax credit and not a tax deduction. It doesn't work that way. When you give money to charity, it's a deduction, which means it reduces your income, which then reduces your taxes. So you have to reduce that income first times your tax bracket. So giving $5,000 to charity may only save you $1,100 in taxes. A $5,000 gift to charity is not going to save you $5,000 in taxes. Otherwise, a lot of people would just give a lot of money to charity at the end of the year so that the money didn't go to the government. They'd rather it go to a charity of their choice rather than go to the government. And pretty much nobody would pay tax in that case, I would guess. But since it doesn't work that way, people don't send all their money to charities. They send them to the government in taxes. Now, let's quickly compare the two. So tax credits directly reduce the amount of taxes you owe. They're more valuable because they're a dollar for dollar reduction. Tax deductions reduce your taxable income, so their value depends on your tax bracket. In general, a tax credit will save you more money than a deduction of the same amount. So let's go through another real-life example. Let's say that you owe $3,000 in taxes and you have a $1,000 tax deduction. Let's say it's a charitable contribution. Let's say you owe $3,000 in tax and you make a $1,000 charitable contribution. If you're in the 22% tax bracket, the deduction saves you $220 in taxes. So now you owe $2,780. It reduced it from $3,000 to $2,780. But if you had a $1,000 tax credit instead, now let's say it's a child tax credit that you can get, or an education credit, those can be about $1,000. So let's say it's a tuition credit that's coming back. You owe $3,000 in taxes, you have a $1,000 tuition credit. Now that reduces your bill by the full $1,000. Now you owe $2,000 for in taxes rather than the $3,000. So hopefully you see the difference there. The tax credit can give you a much bigger tax savings. So it's good to focus on both. It's good to get deductions to lower the taxable income, but also good to focus on the credits that will give you that dollar for dollar offset. And understanding the difference between a tax credit and a tax deduction is crucial for smart tax planning. While both are great tools for reducing your tax bill, credits tend to give you more bang for your buck, like we've gone through those examples there. And if you're looking to maximize your tax savings, work with a tax professional who can help you find and apply the credits and deductions that work best for your situation. As always, for more tax tips from Tax Tutor, tap that subscribe button for tax updates. And also visit us at taxtutor.com and sign up for our weekly newsletter to help you keep on top of your taxes.